Good afternoon, everybody. Hi, Shervin, and sorry for the delay.
Hello.
Just had some technical difficulties that
I
happened.
noticed that. I just want to make sure if you're online. Are we live now?
I see you.
Okay, perfect. Before we start, I want to apologize for the delay. It was a technical issue.
Stress, right? Stress test. So you have stress on a day like this, right?
Exactly. I want to welcome everybody who's here with us today to another webinar by TICRA. I'm Shervin. I'm the acting president of the association, and obviously a proud member of Remax Hallmark. Before we start, I want to acknowledge all our fantastic volunteers who generously spend their time in providing services to our members. And TICRA would not have been where it is without their support. A very special thanks to Bahrami Law Office, Mrs. Firuze Rose Bahrami, who provides legal advices of the association. Mrs. Bahrami has always been a great sponsor of the association from day one, always. So the real estate law office provides all sort of services to our colleagues and obviously to the members of association who get very special rates from Mrs. Bahrami. We're joined today by a very special guest, Mr. Ramy Ibrahim, who not only me, but everybody who's been involved in TICRA actively have a very special connection with him because of all his support and belief that he has towards TICRA and all of us being volunteered. Mr. Ibrahim, because of the delay, I want to ask you to introduce yourself to our attendees today and just tell us a little bit about yourself. Please, welcome.
Okay. Well, thanks. Thanks for inviting me. Thanks for some of the familiar faces that I've met before during and when TICRA was formed several years ago. So I know this is not my first talk, but I've spoken to the group and so forth. About myself, I've been with TD Bank since about 2003, doing, solely residential lending, whether it's mortgages, refinances, purchases, home equity line of credits, and so forth. And in the Greater Toronto Area, obviously. I know I've helped, many of your clients or try to answer as many questions as I can throughout the years. But today's overview, I think I'm going to keep it, give you a historical context of, what led up to the topic of June 1st. Because I think there's a misconception. People just think this happened on June 1st, these changes. That's not the case. We'll talk about what happened on June 1st. And then we'll talk about, how it potentially affects the market. And, we can always open it up to dialogue or questions. So, throughout the presentation, if there's any questions, feel free to put them in the chat and the moderator can gladly ask and I'll try to answer. Maybe I'll just touch on any other, questions that might be dear to your hearts.
Sure.
Along with the stress test. So.
Our attendees have the opportunity to write down their questions, and I'm going to be sharing those with you. But in the meantime, we would all want to hear from you. What happened June 1st, and what was this all story of the stress test, and what is new about it? What is it that we need to know? How much our clients and consumers get affected by it?
Mm-hmm. So I think the misconception is on June 1st is that this is a new regulation or a new change. That's not the case. And I know a lot of us in the media and social media and any news outlet started talking about these changes that led up to June 1st. And again, it's not as a significant change as to the historical changes that we'll talk about. But for sure, I'll touch on that today. Just with respect to what led up to June 1st, as there's really not much the government can do in a low interest rate environment. There wasn't any talk of new policy changes or measurements to take place. When the pandemic obviously affected us, the interest rates, came down, and you've seen, the uptick in the residential mortgage market. So there hasn't been a stop. You've seen the multiple offers, you've seen supply and demand. And I think it's more of a supply and demand issue, but really the government really can't, cool this down, only in one or two ways. And the stress test was one way of showing the general public that, we see what's happening. We're going to tweak it a little bit to try to slow the market down. But personally, I don't think that has done the case. Mind you, everything that takes a change, you won't notice until about 6 months afterwards. So maybe we'll have this discussion come December, and we'll see how this affected the market. But when something is, when a policy is implemented, it takes time for it to shape and form, and that's where you see the after effects. Anytime the interest rates go up or down, anytime there's a new policy. So again, time will tell, but we'll see what happens in December, basically. But again, in my opinion, not really significant measurement, not really a big change. And again, I'll get into the history. And I think the other thing is, let's stop calling it a stress test as well, because, in my opinion, stress creates a negative. It's a qualifying rate. When you're talking to your clients, just, when we're pre-qualifying them or asking them about certain questions, or, in some of the information that you're sending, we'll just talk about the qualification or the rate to basically qualify, and we'll refer to it in that respect, rather than using a negative word like stress. It's always good in your conversations, basically.
Where did that stress test coming from? What made this whole story to become what it is? Is it not similar to what happened in the past as well, to what happened in 2016? Or is it not similar to what would usually we expect from after any changes, just like what happened after pandemic? Can you elaborate on that, please, a little bit?
So this goes back to 2010, and we've been in a low interest rate environment since that time. When I first started in banking, my 5-year mortgages with a discount, probably 5.5%, 6%. There's some of you on this call that maybe witnessed mortgage rates as high as 9, 10, double-digit rates. Maybe there's not. I don't see the birth dates on this call, but there's some people that have experienced even much higher interest rates. But this took place in 2010 is when some of these measurements started, occurring. And the first one that actually happened was, at that time, we used to always qualify people at a contract rate. So a contract rate is your true mortgage interest rate. So, for example, when you take a mortgage term, let's just call it a 5-year mortgage rate, and you signed for a rate of 3.99% or 2.99% or 5%. That is your contract rate. That is the way we used to basically always qualify individuals. So up until 2010, the first change that actually happened to this qualifying rate was, because we were in a historical low rate environment from that time, the government basically wanted to step in, because they're looking at affordability. And when you make a change to a policy or you implement a policy, it's a policy all across the country. So what we're experiencing in the GTA, we've seen the market, keep on going, higher and higher. There have been times where it's come down, but when the government changes a policy, it goes for provinces out in the Maritimes. It goes out to the West Coast. It goes up to Northern Ontario. So some of those areas didn't have a supply or demand issue, or the real estate market didn't go as high as the Greater Toronto area. But the government's going to implement a policy across the country, because it's the federal government. They're the ones that are responsible for this. It is not a provincial tool to make these changes, and basically. So the first one that took place in 2010 said we don't want to qualify you under the contract rate. You basically need to qualify if you're taking a variable term. The variable mortgage rate are terms that fluctuate. They go up and down. You're taking a line of credit. That's what a variable rate is. So the government in 2010 basically said, we're going to change this. And if you're going to be taking any term less than 4 years, 3 years, 2 years, 1 year term or variable term, we want to qualify you at a qualifying rate, which is that stress test rate. So where that name came from, no clue. The government came up with it, but it means a qualifying rate. So that's the first change that happened in 2010. So basically that was when it first started, essentially. But I mean, again, I've always called it the qualifying rate, not so much the stress test rate, basically.
As you mentioned, it definitely has a negative impact to call it a stress, while if we were to say qualifying, it would probably be a little bit of a secure word for to be used for our consumers. Ramy, how do you see, as an active agent in the market, I personally don't think that from June 1st, the housing prices have been moderated or softened. But originally, it was expected to have such effect in the market. How do you see that? How do you see the prices of the housing being impacted?
So again, I think it's a minimal change. I mean, we've gone from pre-June 1st, we were using a rate of 4.79%. After June 1st, we're now using 5.25%. Mm-hmm. So again, it's very, very minimal. Mm-hmm. Most of these clients that I've been helping or trying to facilitate financing for, whether it's a refinance, whether it's a purchase, they're usually your conventional mortgage borrower. And a conventional mortgage borrower is a person that has 20% down or more as a down payment. And your unconventional borrower is a person that's putting down less than 20% down, and you have to get what's called high ratio financing for those types of buyers. So when you're asking if you're asking me about the housing market, I mean, my own personal sense of things is that first-time buyer that needed to put down at least a 5% down payment, a 10% down payment, they've already been removed from this market years ago, whether it started happening in 2010, 2012, 2017. And again, I'll get through that in a minute. So that part of the market in the GTA, and again, we should only comment on, the parties that we serve in the GTA. I can't really comment for other, parts of the country, but the housing prices in the GTA. I mean, it's very hard pressed to find something less than $1 million for that first time buyer. So if you're asking me the question, how is this going to affect things? I mean, going forward, 50 basis point change in a qualifying rate. These are already your affluent clients that are making good income. They're either self-employed, so they're getting financing a different way that we're looking at other documents to help them get financing for and so forth. They might have good net worth. It's a significant down payment. So most lenders, I mean, if there is a situation where they want to help somebody, they're going to look at the whole story, not just the qualifying rate to qualify somebody. So getting back to the question, is this going to impact the housing market? In my opinion, again, that first-time buyer was affected years ago, not so much what happened on June 1st. And again, going forward, the type of buyer that's entering the market on June 1st, a 50 basis point increase in a qualifying rate is really not going to do much for that buyer, in my opinion. What's going to be looked at is, that household income, the property taxes, for that property, utilities, it's the actual budget of the individual. So put the qualifying rate aside, for a minute. When we're talking to customers or clients, I mean, yeah, you want to qualify them and pre-qualify them, and you can give them the maximum number on a qualifying rate or the stress test rate, whatever you want to call it. But you should really be looking at their budget. Do they have kids? Is there, daycare? Is there, car payment? Is there a credit card payment? So what concerns me is more of the debt that, households, might have. That's really what's impacting them, because this qualifying rate, the more debt that you've got outstanding, that will impact you. So if you have a car payment, or you've got a line of credit payment, you've got a Visa or a MasterCard payment, and you have debt on it, that's really going to affect you. In your whole, looking at your whole application, a 50 basis point difference is really not going to make a significant difference, if that answers your question.
Right. All right. Thank you so much, Ramy. Is there anything similar to what we are going through right now to what happened in 2016 with the changes in mortgage rates and the perception of the consumers and the purchasers?
I think, again, that's more of a question that, maybe I would ask you, or, the people that are on PICRA, part of the organization, or the viewers that are tuned in. I think it's more of a supply or demand issue. So what's really going to, affect, the market is supply and demand. That's what affects prices. That's what really, really is the inventory, what builder stock is coming out. So I think, if we don't see a lot of inventory, and I think a lot of households, with what's happened during a pandemic, or, work from home, or, having that access, not to be, confined to a small space, having a backyard, having a pool, getting a cottage, doing work in an alternate way. If this is the way that they want to, sort of look at a hybrid model of work, or going back, to full time, and so forth. I just see a lot of, households, wanting to get back into a bigger home, or trying to do that upsize because rates are still low. And two, they want to take advantage of trying to do that upsize, during the environment that they're in. But I think really the housing stock is really the one that's really going to be the one that's going to really affect that supply demand. That's what's going to push up prices. That's what might push up the need for, mortgage financing. But I do see a lot more Canadian households putting down more than 20% down on properties, because, they've done well on their other properties. They've built up equity, and now they're moving up. So the balances that are being acquired, from what I see, are, lower balance mortgages. So there could be they're 30% down, 40% down, 50% down. That's what I'm seeing, basically. So I think, a lot of these households are doing things that are comfortable for them. They're not taking on a huge debt, basically.
Right. Thank you. How do you see because when I was doing my research about June 1st, a little bit before and a little bit after June 1st, I was coming across a lot of concerns from consumers and myself regarding the first home buyers. Where do you see the first home buyers qualification level to be at this moment? It is a question of, obviously, a lot of consumers that we work with.
So the segment that I refer to as a first-time buyer is the person that's putting down less than 20% down. That's my definition of that first-time buyer, because that other first-time buyer could have 20% down or more. And again, they're looked at a little bit more differently. And I'll explain what the difference is between, the first-time buyer with 5, 10%, 15% down, than the first-time buyer that's putting down 20% down or more. So the one first-time buyer that you might be getting a concern from, or that I see across my desk when I speak to a first-time buyer that's putting down less than 20% down, as I mentioned earlier, these are the buyers that were already affected from 2017. And I'll explain what happened in 2017 as we look at the historical and we move up. And what I'll do is there's a link that I'll share with you, and you can send it out to PICRA that just talks about some of the historical data after we wrap up, just to sort of talk about these points. But basically in 2017, what had happened is the qualifying rate, I touched on contract rate a few minutes ago during the presentation. The qualifying rate at that time changed on all products, even a 5-year term. So overnight, we were dealing with a lot of first-time buyers that the qualifying rates that changed back in 2010 and 2012 that I spoke of earlier, when they were getting terms less than, that were 1 year, 2 year, 3 year, 4 year, and terms that were below 4 years plus a variable rate, they were basically getting qualified at a contract rate, their true rate. Then it went up to the qualifying rate. 2017, the one that was excluded was the 5-year term. That took effect, where the government said, we're going to implement the qualifying rate even on a 5-year term. So a lot of first-time buyers like taking a 5-year fixed mortgage because they get a peace of mind. They don't want to take a risk that they're taking a short-term rate or variable term. So you hear a lot of people always talk about a 5-year rate.
Right.
Well, at that time, my 5-year contract rate was, I think, 3.3%. And the qualifying rate went up 2% to about 5.3%. So at that time, that segment of the market was already flushed out. And I really haven't done a lot of first-time buyers since that time. And mind you, those price points were a lot cheaper in 2017.
Correct.
So fast forward into 2021, prices have gone up even more. Same first-time buyer that had the qualifying rate changed by 2% overnight. And now at a much bigger price point, it makes it very, very impossible, unless it's a condo to really get into, or you're going to have to shift your first-time buyer that's looking for a town or a semi or a single out of, Toronto, and you're going to go east, as north as possible, as west as possible. Then you might be able to deal with that segment of the market. The other thing you've got to remember with that first-time buyer, they're capped at $1 million. So the government says you can only go up to $1 million because we'll only provide insurance on properties that are $1 million and less. That first-time buyer.
Right.
So it's two things. One is the price point, which can't exceed $1 million for the first-time buyer that wants to put down less than 20%. Plus it's the qualifying rate, which I mentioned really took place in 2017, not on June 1st.
Right.
So that segment of that first-time buyer, unfortunately, has been affected since then. I was a first-time buyer. You're going to laugh. My first condo was $85,000, 5% down. I'm not going to tell you what my income was, but if I was that first-time buyer today, I wouldn't get into the market at 5% down using that same salary and also using the qualifying rate that took effect, basically. Now, the other segment of a first-time buyer is that buyer that is looking for $1 million or more. They need to put down 20%. And the qualifying rules are a little bit easier when you put down 20% down or more, because it's twofold. One is less than $1 million, you can have the high ratio insurance, but we can qualify you over a 25-year amortization. But when you do 20% down or more, we can qualify you over 30 years. So an extra 5 years makes it a little bit better for any buyer, including the first-time buyer, including the repeat buyer. Why? Because they're putting down at least 20% down or more, that we can play around with the amortization and stretch it out. So we have a little bit more room to look at these, qualifying contract rates, and a little bit more room because we have a little bit more equity. It's really up to us as a lender. So we can make an exception anytime. It's not just looking at a person's income. It's a whole bunch of factors. Do they get rental income? Do they have money on their corporation statements? What's their down payment? What's their net worth? So that's still up to us within reason for us to qualify any file. But once you're under $1 million and you're putting down less than 20% down, the government insurance companies have to qualify you. It's their rules, their regulations. We just follow when they approve it, and we'll give the money, but we have to fit that box. So getting back to your question, there's two different first-time buyers. And in my opinion, that first-time buyer, June 1st or way before June 1st, was already affected regardless, just because these price points have gone up so much. Property taxes have gone up, maintenance fees have gone up. So things will basically impact the adjudication of that file.
Yes, thank you so much. And obviously, according to what you went through in depth, the affordability has been affected for a lot of our buyers, whether they are first home buyers or not. Ramy, where do you see us going from after COVID opening and for the rest of the year 2021? We passed half a year already, and where do you see the mortgage is taking us to, and all these changes that were coming in? We were not expecting it after the COVID.
So, I mean, it's a good question. I think, again, it's really going to depend on what our housing stock is. I feel, there's a lot of people that are hesitant to maybe list their property because they don't know what they might buy, what they're going to get. They're going to give up their current property that they're used to. And then, they get into another, property that, is going to cost them a few more dollars and so forth, that they might say, hey, you know what, I'm going to stay put. I'm going to renovate. And you can see the renovation stats going up. You can see, the cost of goods going up, whether it's lumber, any other, home improvements, that people are staying put in some of their homes because they feel, okay, well, my house is worth, $1 million and change. And, this next house, for me to upsize, for me to make a significant move, really has to be at least $1.5 million or more. Because to do an upsize from $1 million to $1.1 million and $1.2 million, there's really not much difference in terms of what that buyer is going to get. So it really means taking on more debt. Having said that, less listings hit the market, then again, it's that supply demand issue. And then once things open up, whether it's immigration, whether it's, we sort of understand, how these offices and how these employers want to give their clients a choice. When I say a choice, maybe they'll give them a choice to work from home. So that's going to, have them look at maybe, a bigger, place.
Right.
It might make them look at getting a secondary home that, they want to be in a cottage, on Thursday, Friday, Saturday, Sunday, and they'll buy a secondary property. So I think time will tell, but really, the housing stock is going to be key. The more people that once immigration opens up that come into Canada or come into the GTA, traditionally those people want to buy. Now, they don't buy right away when they move here. They want to get settled first. It might be a year or two, but still, everybody wants to be that new immigrant that comes over wants to be a homeowner. And I think, once the borders open up, again, you're going to have more people, because right now, I really haven't done a lot of new immigrant files or a lot of non-resident files because of the fact that, the borders are, shut down. So time will tell. But again, that puts pressure on supply and demand. And, I know a lot of the realtors on this call, it's really up to those conversations, those listings that are coming to the market to basically, keep that stock going. It really depends on the new home builders as well. On their developments, some of their permits have been delayed, and so forth because of the shutdown. Once things open up, do we see more housing stock coming in from the builders? And then a lot of those builder investors as well that bought, a few years ago, they've seen these significant price changes, that might bring more housing stock as well. But, time will tell. I think we just got to go back to normal, what that normal looks like and when it's going to be. Then we'll sort of get a better idea of where this market's going at that time, I think.
The province starts opening up and
right.
for the country. All right. Thank you so much. I have a question here by Sarah Kelali. Is it true that people who already have purchased and they have already been approved for a mortgage are going to be reassessed, or this new qualification rate or test will apply on them as well?
Okay, so every lender is going to handle it differently. I can only tell you what I'm going to look at.
Mm-hmm.
I'll still consider a purchase and sales agreement that was signed by a builder before June 1st, or a resale agreement that was signed before June 1st.
Mm-hmm.
We'll consider it under the old rules. Mm-hmm. Some other lenders it's going to be no. They'll consider it under the new rules. I mean, to give you a stat, I mean, the difference of a mortgage. I'll give you an example. I mean, if a person has a down payment of $100,000, and they were looking at going into a mortgage of at least 20% down. So let's just call it $500,000 purchase price, 20% down, which is $100,000 basically. So the new rules, 4.79% as opposed to 5.25%. We were going to change our mortgage qualification by about 2 to 4%. So it's not really a significant difference for that individual. I mean, it might be on the larger mortgages, like if you're applying for $1 million, obviously 2 to 4% on $1 million, could be $40,000 in a mortgage difference. But on 500,000, could be about $20,000. Not a big difference. The big key is that unsecured debt that person has, whether it's the car loan, lease, credit card payment. That's the one that's really going to be key, because we look at two factors when we qualify a person: a gross debt service ratio, and you might have remember this when you did your licensing, and there's a total debt service ratio. So the gross debt service ratio looks at the mortgage principal and interest payment, property tax payment, and the utility payment on the home. And typically, if a person's credit is good, we go as high as 39% in some cases for those individuals. And a total debt service ratio is the principal and interest payment, any credit card payment, loan payment, or lease payment, the housing utility, and the property tax payment. And typically we go as high as 44%. So it's really the other debts, the car loan, the lease, the credit card, that we can stretch to about 44%, rather than the first one at 39%, which is just the gross debt servicing cost. So it really won't make a huge, significant difference. Okay. But in my opinion, before you take out somebody, to be precious of your time and understand, what your client, is going to qualify for, just ensure you're speaking to a qualified mortgage professional that will assess the individual, see what other properties that they have, see what they're all about. And we'll tell you, if we feel we're going to help and pre-qualify those individuals to make sure they're not impacted, whether it's, pre-June 1st or after June 1st, basically.
Right. Got it. Obviously there's a lot of information that we can learn from you, but I wanted to know if people who want to refinance or renew their mortgages, how would they going to be? Has there been any change impacting them as well, or again, there hasn't been a lot of changes affecting those type of consumers?
So again, for the qualifying rate for a renewal, I can only comment on our policy, and most of the major lenders are the same. We won't look at any requalification at all for that individual. Got it. So if your mortgage is coming up for renewal and it's $500,000, and all you're renewing is $500,000, we're going to send you the best rates we can give you, and you're going to sign back and take that offer. Right. If you want to come back and you want, let's just say you want $550,000 because you want to, fix your basement, or you just need the extra money to, consolidate debt, we need to go through a brand new application for, let's just say, $550,000. So then, yes, you're going to basically, requalify, and you're going to be subject to the qualifying rules and rates. So that's going to be deemed a refinance. So yes, you would. A renewal, no, you don't have to. Right. If you're taking out maybe like a home equity line of credit, and I do a lot of these, and let's just say that, you've got an existing mortgage. So your renewal is coming up for $500,000, let's say, and you want an extra $50,000. So rather than me, because I have access to a line of credit, a lot of mortgage brokers don't have access to line of credits, or a lot of the smaller lenders might not, or a lot of the larger lenders will. I've got two options. One is I refinance you for the $550,000 which is going to be tougher because I have to use a whole new qualifying rule. So your contract rate on that $500,000 that you're paying right now, it might be $1,000 principal and interest a month. So if I apply for a line of credit for you, I'm going to use your contract rate, which is $1,000, and I'm going to just qualify you for $50,000 for a home equity line of credit, which is very minimal. But if you come back to me and you want to apply for a mortgage of $550,000, that qualifying rate, because it's almost double, because it's like 2% more, that qualifying rate is now about $2,000. So it's going to be a lot tougher for you.
Mm-hmm.
There's different ways we can get around the stress test if you want extra money. But I mean, again, not all lenders will access or give you these options, basically.
All right. Thank you so much, Mr. Ibrahim. It was very, very useful. I personally learned a lot, and I'm sure our members and viewers will take advantage of this video being on YouTube. I appreciate your time, and on behalf of everybody involved at the board and all the volunteers, I thank you for your time, and I want to thank Mrs. Ramy for her sponsorship, and also last but not least, Canada Create for providing us with this connection and making it possible for us to have this regular webinars. Thanks a lot, and happy Canada Day from today. We're 2 days away from Canada Day.
Oh, thank you.
Thank you.